What's up, guys? Welcome back to DCA. So I'm just going to make a quick video today, and what I want to do is take a look at Solana. Now, specifically, I'm going to be looking at possible entry and exit points. When we see a pullback like we've had over the last week or so, I think it's important to identify not only what are points where we may come into resistance at on the way up, but on the way down, if you're still looking to get into the asset, where might be a good place to get in? So I'm going to use the identical metric that I used in my last video. And, I'm not going to, be using this metric in every single video I make, but I think it's for the average investor, I think this is a great tool in order to help yourself to identify where is a good place to get into the market. Because, a lot of times let's say we're sitting up there at around 240 bucks and you may be asking yourself, well, should I get in now? What do I do? Should I, sit on the sidelines? Is if we go down to 220, is that a good place to get in? What about 200? All those kind of questions might be going through your head. And I think that's one of the big questions that a lot of investors wrestle with is timing of the market, or even if they're not trying to perfectly time the market, even if you're a long-term holder, you still may be interested in finding exit points in the market. This is a metric that I frequently use on this channel for the reason that it's number one, very simple to use. It's very easy to use and, it doesn't require any, advanced knowledge of technical analysis or anything like that, okay? The second thing is I think it's one of the most reliable metrics in the entire crypto market for the reason that the crypto market remains to be, in spite of all of the institutional involvement we've had, it remains to be a retail dominant market. And because of that fact, we know the patterns of retail investors and they're very predictable and they're cyclical. They happen over and over and over again. And because of that, we are able to identify where those areas where retail investors are heavily allocated and what's likely to happen when we approach those zones. Okay. So I'm just going to quickly explain what this metric is. If you already know how to use the volume profile visible range, you can just go ahead and jump ahead in the, in the bookmarks. But if you're unfamiliar with it, I'll just do a quick overview of how to use this metric right here. So over on the right, you'll see that we have these horizontal bars, okay? And what these bars are telling us, you'll notice that they, we could go to any given price. Let's say, let's look at 150 bucks. Okay, so you go to 150 bucks and you look at this horizontal bar, and that gives you an idea of the relative amount of volume that has been traded at that level. And what that will mean is if there's a high amount of volume being traded at $150, it is very likely that you're going to find an area of support at that level if you're coming down. Now, if you're below that $150 level and you're on the way up, it's very likely that it's going to be an area of resistance. And the reason for that is simple. When someone, just to give a brief example, and, I just talked about this in my last video in the Cardano video. So like I said, if you already know this stuff, you could just jump ahead. But the reason is that if you've been an investor in Solana, and let's say you bought the top back here in 2021, you were sniping Solana at 210, let's say. And then we dropped down to $7, right? So you were down, over 90% on your investment. And when you got back up to 210, back here in November, when you got back up to that 210 level, you may have said, you know what, that's as good as I'm going to do. I made a $10,000 investment or whatever it may be, a $1,000 investment, and it was all the way down to 80 bucks or something like that. So I'm going to get out when I'm back to my $1,000 because that was a miserable ride, sitting on that Solana that I watched go from $1,000 or $10,000 down to, just a mere fraction of that. So when you come back up to that level, right? When you come back to those levels, that person is very likely to get out. So now imagine if you're sitting here at like 150 and we go down to $7. The same principle applies. When we go down, there's a huge number of investors. Now at the 210 level, there weren't many investors, right? Because not too many people can buy the top. But when you go to one of these levels where we sit at for a prolonged period of time, you accrue investors, right? And then when we drop down to $7 or $10 or whatever it may be, there's a huge number of investors. Sure, a lot of them capitulate, that's expected, but a lot of them don't. And so what we'll find is that when we come back to their level, very frequently we'll see a sell-off there, or maybe not a sell-off, but that will be a sticking point for that particular asset, because of the fact that you're running into a bunch of people that were down a large amount of money and now they're selling the asset. So on the way down, the same kind of principle applies. If we're coming from, let's say, 250 back down to 150, and we know there's a ton of investors there, well, those people now were at a big profit at one point, and now they're back at their starting point. And you're going to find that very frequently they won't sell. In fact, they'll defend their price level. Okay. So on the way up, it's a area of resistance. On the way down, it's an area of support. And what you want to do, that's the major concept you need to understand. The next thing you need to understand, and once you understand these two principles, you pretty much have the whole thing covered. Areas where there's been a large amount of volume, like here at the 150 level, that's going to be significantly more support or resistance than, let's say, like an area like 230, okay? Like an area like 220, okay? Those are very low volume areas. In fact, quite simply put, they're called low volume nodes, whereas these are called high volume nodes. And so the principle is, when you move into high volume or low volume nodes, these are difficult to move through. You get lots of bounces off of those levels. You'll bounce off that level frequently. When you get into these areas here, like look right here. So right at 195, what happens when we get to 195? You'll notice there's very little volume in this area, right? Very little volume, especially relative to the areas directly adjacent to it. There's very little volume here. What happens when we go above that? Well, let's look historically what has happened when we go above 195. Boom, we rocket right up to around 260. And again, we got back there this year. Boom, we rocketed right up to 260. Okay? So that is the main principle at play here. Once you understand those two things, you have pretty much everything you need to know about this metric. Let's take a look at Solana then. And remember what I said. So we're sitting here at 229. Now, if we take a look at our volume map over here, we see that we just came right down to this area right here. We hit this $200 level. You'll notice that this node starts to become a bit more prominent than those directly adjacent to it. That's fine. It's still a pretty low volume node. So why did we get a bounce right there then? Why not go all the way down to, like our 190 level? And that's because in addition to the the major volume areas where you have investors distributed, remember, you also have psychological levels, right? It's like Bitcoin. We hit 100K, and it wouldn't take a rocket surgeon to have guessed that 100K was going to be a sticking point for Bitcoin, right? Because once you get to that 100K level, it's like it's a psychological thing for investors. They like round numbers. So that's why when we had this big correction here coming from 260, we bounced right off of this 200 level. Okay. And otherwise, this is a pretty low volume area. It's why the price, these candles are huge in here. We're just flying down and we're flying back up. But now, importantly, we are coming up, and it's not the biggest amount of resistance in the world, but we are coming up to a very small resistance zone right at around the 240 level. That's why the price where we're sitting at right now is kind of slowing down, right? We're not just flying through this level. So that's one place to look for above us. Now, like I always say with this metric doesn't help us with price discovery. If we start going, above our prior all-time highs, then we're just in a completely different realm. So it doesn't help us on the way up, but it's still relevant because it helps us understand if we start to fall back down, as we do, even when we make all-time highs, right? Even if we were to go to 1,000, it wouldn't just be a straight shot to 1,000 here. What it would do is go to, 350 and then bounce back down to whatever. And we could use this metric to help us identify where we're very likely to find our bounce levels at. All right. So what we can do then is, let's say we keep going down from here and you as an investor are interested in trying to determine what might be a good place to get into the market at. Where might potential bounce levels come at? Okay, so we know the 200 level, that's one we could watch for, but then it's once we get below that where, much stronger support is likely to form. So we have, starting at this 190 level, that's where we have this more prominent high volume node, okay? And you'll notice that it's a gradient. Now, Solana is a bit unique in this sense because it doesn't have a lot of these assets will be very prominent in one place and then there's a massive gap and then very prominent. But what Solana does is pretty interesting. It builds this volume gradient and we build it all the way down to 150. Now, what that tells me is that there's a few areas where we could look for a bounce. My first area I would be watching for is right around this 190 zone, okay? Then I'd be watching as we move down to 170. So those are like two potential areas where you could be looking to enter into this asset. Now, the level below that would be this 150 level. That's a critical level. If we lost this 150 level, I think we would kind of be in trouble, right? Because this is where the market will put up the big fight, right? And oftentimes what you'll see with levels like this, like either this 150 or down to this 100 level, if you lose those levels, it's a pretty good indication that the bull market might be over, unless it's going to be a very protracted and a prolonged bull market. But if we lost that level, that would be a pretty good indication that this particular cycle may be over or might just need much longer before we're able to continue heading up from there. Watching for this 150 level. So ultimately, this is a level we definitely want to hold. And it might also be, if we were to get down there, I think that would be a potential area where you could, you'd want to be cautious here, but it would be a good entry point if you were able to get back into the asset at that level. All right. Like down to this, basically we're talking about like 130 up to 150. And remember, because this is it's a dynamic fluid process, we're not pinpointing, like I'm not sitting here telling you like, oh, 150 on the nose, that's what you want to be looking for. That's not how this metric works. We're looking for areas where we have established that there is a large amount of volume. And when we understand that, then people might front run. It might go slightly lower on like a wick. You'll see a quick wick drop below some of these levels. Like, we've seen many wicks drop below this 150 level. But the candles, you'll notice the bottom of the candle tends to form right around the 150 level, like the 135 up to 150 level. Okay. So you won't use this metric to identify a specific identical or, a specific exact price, but you can give yourself a very good idea of where it's likely to turn around in your favor if the bull market continues, right? Now, if it heads into a bear market, like losing this level, like I said, like down to this like 130 level, that would be a pretty good indication to me that it's time to get really cautious and really selective in how you're approaching the market. The last thing I want to talk about is this. This is the website I run with Mark over at Upside Down Data. It's polaritydigital.io. And what I'm showing you here is the price is in white for Solana, and in green, we have our risk metric. This is our long-term risk metric. Now, we also have trend analysis models. We have short-term risk metrics and medium-term risk metrics. But this one is our longer-term metric. So this metric plays out over a time frame of months to years. Okay, so we're talking about the very big picture here for Solana. And the way it works, if you don't know yet, when we're up here at 5, that indicates that the market is overheated and very likely to sell off. When we're down here at -5, these tend to be the very best times to buy the asset. And you'll notice that, this metric absolutely perfected Solana so far. So in the bear market, when we got down to right at around $9 or whatever it was, $10, the metric was saying, the metric was at -5, indicating this is the optimal time to get into the asset. And back here in December, the metric was showing that this market is very overheated. The metric was telling us that, okay, we went on this run, we had a correction. We went from, around 120 all the way down to, at our lowest, around 90. The metric was kind of reset from there. And yet again, when we got up here to our peak at around 200, the metric was telling you, hey, this thing's looking a little overheated right now. It may be time for a cool off. And that's what we saw. Okay, but we formed this pretty solid support level at around 130, which the volume profile visible range indicated to us. The metric cooled off, and now we've started to go on a run. Now, the way this works, typically when you get up to above this 4 level, that's either indicating to you that, we're going to need at least months in order to cool off from here, or very likely this market cycle could be over. So it may be time to start liquidating some of that position. And you'll notice that right now we're sitting at a 2 on our risk metric. So there is still plenty of time to go for Solana, or at minimum, there's still a lot of potential to go from here. Now, like I always say, we can't predict exactly how this market's going to play out, right? We don't know if we're going to see a turnover from here. And that could be something exogenous to the crypto market. It doesn't need to necessarily indicate that the crypto market is going to crash in isolation, right? Like if the NASDAQ started collapsing, if the S&P started falling to the downside, you're going to see the crypto market go with it. That's just the name of the game now. So this is just telling us that, where we're at right now, even though we're up here at around 230 bucks, there is still plenty of room for Solana to go to the upside before things begin to get overheated to a severe degree, at least for this individual asset. What I've done today, it's not necessarily to tell you, this is where you should get in, this is where you should get out. It's giving you a framework for identifying potential locations instead of just, throwing your hands up in the air and saying, I'm going to buy some Solana today. So it makes a lot more sense to be patient, pick your spots when you're getting in, and, using a broad range of metrics in order to help yourself identify what are the best positions to get in and out. So with that said, that's going to be it for this one, guys. Until next time, as usual, see you.